Investing in apartments can be lucrative, but it's important to be prepared. You need to understand how different factors can affect your returns. This is where sensitivity analysis comes in. It's a powerful tool. It helps you assess risk. It shows you how changes in key assumptions impact your investment. Think of sensitivity analysis as a what-if game. What if rents don't grow as fast as you expect? What if vacancy rates rise? By playing out these scenarios, you gain valuable insights. You can make more informed decisions. You can protect your investment. Sensitivity analysis is not about predicting the future. It's about understanding the range of possibilities. It helps you prepare for different market conditions. Whether the market goes up or down, you'll be ready. You'll be confident in your investment decisions. When analyzing an apartment investment, several key assumptions come into play. These assumptions form the foundation of your analysis. They can significantly influence your potential returns. Understanding these factors is crucial for making informed decisions. Rent growth is a major factor. How much can you increase rents each year? Vacancy rates are also important. How many units will be empty at any given time? These factors directly impact your income. Another key assumption is the cap rate. This metric helps you estimate the property's value based on its income. A lower cap rate means a higher property value. Conversely, a higher cap rate suggests a lower property value. Finally, you need to consider expenses. These include operating costs like property taxes, insurance, and maintenance. Now, let's build different scenarios. We'll start with a base case. This represents your most likely outcome based on current market conditions and your due diligence. Gather data on comparable properties, local market trends, and expert opinions to inform your base case assumptions. Next, create an optimistic scenario. Here you assume favorable conditions. Think higher rent growth, lower vacancy rates, and controlled expenses. However, it's important to be realistic. Don't get carried away with overly optimistic projections. Finally, develop a pessimistic scenario. This scenario considers potential downsides. Factor in lower rent growth, higher vacancy rates, and increased expenses. By analyzing this scenario, you understand the potential risks. You can prepare for challenges. Numbers alone can be overwhelming. That's where visual aids come in handy. They help you understand the impact of sensitivity analysis more clearly. Use tables or charts to present your findings. For instance, you can create a table that shows the IRR, cash-on-cash return, and cash flow for each scenario. Visualizing these metrics side by side makes it easier to compare and contrast the potential outcomes. A chart can illustrate how changes in a single variable such as rent growth can impact your overall returns. By presenting your sensitivity analysis visually, you gain a clearer understanding of the potential risks and rewards associated with your apartment investment. This allows you to make more informed decisions and adjust your investment strategy accordingly.